The number of homes sold in January of 2022 was 6,784. The number of homes sold in January of 2023 were 4,071. The number of active listings for sale in January of 2022, 5,201. Versus January in 2023, the active count was 15,552. Those are some pretty big differences when it comes to supply and demand, but does that automatically mean that our prices are coming down? That's what we're going to dive into right now, because although those numbers are pretty drastic, it does not tell the complete story. In fact, there are many out there that continue to talk about how the housing market is going to crash. And some that have been following some specific YouTube channels that have been talking about a housing crash for over 2 years. Yet the data they're using is very selective to demonstrate what they want you to believe. And I have a few examples of that, so make sure you stick around. Now, I talked about this in a previous video, that the interest rates dropping and the rise in demand in January really caught a lot of people off guard. Now, it's normal to see a rise in demand in January, but with what our market had been going through, having it happen the way that it happened this January was a little surprising. So just to show you how drastically the listings under contract went up in January, take a look at this. Now, I know we're below the last 2020, 2021, and 2022. However, this is January, and this is a significant spike that we saw the homes go under contract. Now, you may have seen or heard stories from real estate agents about how much more activity their homes were seeing. We were starting to see a lot more buyers out in the market in January. We also started to see some multiple offers again. Now, before you jump all over me because I said multiple offers, this was nothing like we saw before. But for those homes that have been updated in the right location and the right price, we did and are still seeing some multiple offers. Now, I wanted to bring you back into this listings under contract to show you the year that we are tracking with most similarly, just so you can see, and that is 2019. Now, I don't know that we're going to spike up as high as 2019 did, but right now we are tracking very similarly to 2019. So tracking pending sales is really important, and here's why. As we look at the sales per month, you can see that January sales kind of started to dip, but why is that? This is because January sales, the contracts for those houses were written in December. And December, by the way, was one of our slowest months. So we saw our contracts go down in January, but then they start to tick up as far as sales are concerned in February, because those contracts were written in January when our interest rates were lower, and we're seeing more sales now in February than we did in January. So how is this affecting our sales price? As you can see, this is our monthly median sales price, and we peaked in May in 2022, and then we did start coming down until December. In December, we hit kind of a flattening, and we see our median sales price at $415,000. Then we go into January, again, $415,000. And into February, we're still at $415,000. So from December of 2022 to February in 2023, what have our prices done? They've gone completely flat. So yes, we did see about a 14% decline in overall home prices from the peak in May to December. But as we stand right now, our prices are doing absolutely nothing. They're just stagnating. And the disruptor of all of this has been interest rates. The interest rates rising almost a full point in the last about 2.5 weeks has actually pushed buyers back to the sidelines. And the $1 million question is, what's going to happen with interest rates now? And this is one area of the market that no one can predict. Now, I admit that I did not think that we would see our interest rates get as high as they are right now. And I was wrong about that. And the biggest factor to our interest rates rising most recently is the recent jobs report. Because if jobs are going up, meaning the unemployment is going down, that means that interest rates will go up. But if they're going up, how far will they go up? And how long will they stay? No one really knows. Will they come back down again? That could happen too. No one knows. To see the health of our overall real estate market, we take a look at our contract ratio. This shows us what's under contract and what's on the market, and it shows us the strength of the supply and demand in our market currently. Now, this is not seasonally adjusted, so as our market changes, this can swing rather rapidly, as you can see from this chart. And the biggest positive that we have right now is the number of homes that are actually going under contract. As you can see right here in January, it started to increase, which made our contract ratio start to climb. And it's been climbing ever since January. And these positive signals continue to grow despite the craziness of the interest rates. With each passing week, we have fewer expireds, fewer canceled, and more homes under contract. From here, it's good to look at the Cromford Market Index. Now, this is seasonally adjusted, so it will move much more slowly. And this is a leading indicator which will show us where our prices are actually heading. See, first the CMI moves and then appreciation moves, whether it be up or down. When you really start looking at this chart, you can see the drastic swings that our market has taken over the last few years. But the big thing to remember is that the last 2 years have been anything but normal. So you can't really take the last 2 years and compare them to now to equate it into a market crashing. To quantify a crash, you have to look back at the data even farther than 2 years. And right now, our market is tracking, as we said, closer to 2019. Now, when people start talking about which direction prices are going, if they're going down, what we would start to see in our market is an increase in our price reductions. And normally this time of year, because we start seeing more inventory come on the market, more competition, we see an increase in our overall price reductions. See, and looking at this chart, you can see tracking all the way back to 2015, it's normal for us to see increased in price reductions in January, February, sometimes even into March. This dip right here that you see in every single year, this is always December. And then it ramps up again in January, February, here's March again, then back down in December. January, February, March, back in December. All the way up and down, all the way through all these years until we get to our crazy years. And then this just went a little bit wonky, but here's December again, right here, December, January. We did see some price reductions, but now the opposite's happening. We're in January and we're seeing our price reductions actually start to fall. So for us to see any downward pressure on our home prices, we would need to see our price reductions increasing, not decreasing. Now, I am not by any means saying that we are going to start seeing our prices go up. I do not believe that at all. In fact, I do think that we are going to start seeing some more price depreciation, just a little bit. I don't think it's going to be as drastic as we saw that 14%. And overall, I think we're just going to see some stagnation in our pricing. Now, for those of you that are watching other YouTube channels that continue to say that the Phoenix housing market is crashing, and I know everything is bonkers, but let's take a look at a few headlines and some real data behind them. So this first headline that we're going to take a look at, this is what it says. Phoenix housing crash getting bad. 200% surge in homes for sale. What he's saying in this is that our inventory has increased, which it has. He's looking back at the past 7 years and trying to justify what our normal inventory levels look like. But the truth is, that's not our normal. See, the last 2 years were so low that it completely skews that number. So here's a chart of our actual inventory over the past 18 years. This will give you the full picture. And when you look at it, you notice that 16 of the last 18 years, we actually had inventory higher than where we are now. Some of those years were before the housing crash in 2008 and some were after. So the reality is our inventory has grown, but it is still historically low. And this is why our pricing is not falling off a cliff. Yes, they have come down, but they are not crashing. Now, one of the other YouTubers that continually talks about a housing market crash has recently talked about investors going bankrupt, and therefore they're going to have to do short sales and foreclosures. Let's take a look. So when you take a look at this chart, this shows the percentage of home sales by intended use. And this pink number down here are our investors. And Q2 of 2022 is when the investors started getting out of the market. And they've already come down into what our normal range of investor-owned homes are for the Phoenix market. Now again, with our inventory low, these investors, if they've been remodeling these homes, they can lower the price just a little bit because the homes that have been remodeled and updated, those are the homes that are selling more quickly. And by lowering the price, it would likely get these homes to move. In keeping with the foreclosure theme, there's another video out there and it's titled this: Banks foreclosing on bad loans, millions in default, huge discounts coming. Let's just take a look at our foreclosures here in the Phoenix market. This is a chart that shows the notice of trustees sale, and this is the leading indicator into our foreclosure market. So let's take a look at where we are right now. We are at 400, there are 409 in January. As of February, we have 35. But if you take a look at this chart in the length of time that I have all the years up on the chart, we are still significantly lower than we were even previous to the housing crisis of 2008. Now, he also goes on to talk about how people right now are getting bad loans. Take a look at this chart. What this shows is that the higher the number, the easier it is to get a loan, i.e. the subprime loans. The lower the number, the harder it is to get a loan. This is just another false statement. He then goes on to talk about how people are not putting the same amount of money down on their homes, so they don't have a lot of equity built up in their homes right from the start, which most of the people that I have helped when they've moved, they've taken all the equity out of one house and they've put it into the other house. So I've seen majority of the people put in 20, 30, 40, 50% equity in the home when they purchased it. And don't forget about all those buyers that we had that were paying cash. All of this to say, just be cautious about where you're getting your information about the real estate market. It is hyper local. So you can look at it on a grand scale, but unless they know what is exactly going on in our market every day, it's really easy to make these broad brush statements without knowing all the minutia. And before you say, I think everyone should buy a house, I don't think everyone should buy a house. It is not the right time for a lot of people right now to buy a home, and that's okay. But if it's not a right time for you, I do think you should be making a plan so that when the timing is right, that you are ready to go. Now, I will not be surprised to see our demand wane over the next month or two as interest rates bounce around. Because as we see the interest rates bounce around, I believe we're going to see our demand bounce around. But with our supply still shrinking, I do not see massive downward pressure on prices. Now, if you like this video, make sure you take a look at this one. If I can ever answer any questions for you, please feel free to reach out. As always, I thank you for watching, and I'll see you next time.